Have you ever felt that gnawing unease as headlines scream of impending economic downturns, a chorus of conflicting voices painting a landscape of uncertainty? It's a familiar weight, this pervasive anxiety surrounding recession predictions, leaving even the most ambitious investors feeling adrift in a sea of data, unsure which way to turn. The deluge of information, often superficial or driven by fleeting sentiment, can make us feel as though we are constantly reacting rather than truly understanding the deeper currents at play. This constant striving to decipher market signals, only to be met with more confusion, can erode confidence and foster a deep-seated fear of missteps in our journey toward financial mastery. Too often, conventional recession forecasts, broadcast with an air of certainty, are built upon a shaky foundation of easily observable, yet often misleading, indicators. They gloss over the intricate, almost poetic, interplay of economic forces, leaving investors vulnerable to reactive decisions rather than empowering them with proactive, strategic insight. We find ourselves, metaphorically speaking, standing on the shore, watching the economic tide, but without truly comprehending the ocean's depth. As Warren Buffett wisely observed, with a clarity that cuts through all pretense, only when the tide goes out do you discover who's been swimming naked. This profound truth speaks to the moment when the hidden vulnerabilities, the ill-conceived strategies, and the superficial understanding are brutally exposed. We are here to ensure that when the tide recedes, you stand clothed in wisdom, not caught unawares. Our journey today is about much more than predicting the next downturn. It is about cultivating a profound understanding of economic cycles, equipping you with a critical, data-driven framework to truly discern nuanced recession signals. We aim to transform your experience from passively consuming news to actively engaging with the market, making informed decisions that align with your long-term vision for sustainable wealth. This is a space where we deconstruct market narratives, connect complex financial theory to practical application, and reveal the genuine underlying mechanisms that distinguish effective strategies from mere noise. Are you ready to move beyond the surface, to feel the solid ground beneath your feet even amidst economic tremors? Over the next moments, we will gently peel back the layers, revealing 7 hidden truths in recession prediction, insights often overlooked in the rush for quick answers. These truths will empower you to challenge the consensus, to find your unique edge, and to navigate the market with a quiet confidence that stems from deep understanding. We will move together from market anxiety to a serene, informed navigation, fostering a path toward true financial independence and enduring prosperity. The quiet sting of feeling consistently behind, reacting to news that merely confirms what has already happened, often stems from relying on lagging economic indicators. Official announcements about GDP or unemployment rates, for instance, arrive asterisk after asterisk a downturn begins, leaving investors feeling outmaneuvered and fostering a distrust in conventional guidance. This widespread reliance creates a deep-seated fear of financial loss and investment inadequacy, making us question our ability to navigate volatile markets. The myth that economic headlines offer immediate, actionable insights is deeply misleading. By the time a recession is officially declared, the market, in its forward-looking nature, has usually already priced it in, or even begun its recovery. Relying solely on these delayed signals renders reactive strategies ineffective and often costly, leaving you perpetually behind, swimming against a tide that has already turned. The story of Jesse Livermore, often called the Great Bear of Wall Street, reveals the profound power of independent thought. He didn't wait for official declarations or consensus opinions. Instead, he anticipated market shifts by observing underlying behaviors and market psychology, not just reported data. His success underscored the critical importance of data-driven analysis over blind adherence to market sentiment. To truly navigate these waters, we must cultivate a discerning eye rooted in behavioral finance and quantitative analysis to distinguish leading from lagging indicators. First, learn to identify sentiment shifts in consumer confidence or purchasing manager indices. Second, track the nuances of yield curve inversions, a phenomenon that has historically whispered warnings long before any official declaration. Third, monitor real-time credit market health and corporate cash flows. These act as vital early warning systems, offering glimpses into the economy's true vitality or vulnerability. Dissecting these truths may initially wound your financial confidence, revealing how conventional wisdom can subtly mislead. Yet, this discomfort is a sacred part of growth, a necessary shedding of old skin. It ultimately leads to stronger decision-making autonomy, empowering you to look beyond the obvious, feel the market's rhythm with your own senses, and act strategically, not reactively. Are you ready to embrace this journey of deeper seeing, to find your own independent path through the shifting tides? Have you ever felt that quiet tension, a cognitive dissonance, when the yield curve's predictive power is lauded, yet conflicting headlines leave you unable to truly interpret its signals? This confusion often leads to analysis paralysis or misinformed panic, because a deeper understanding beyond superficial reports feels just out of reach. It's a frustrating dance, caught between the promise of insight and the reality of overwhelming noise. Beware of confirmation bias disguised as prudence. This error causes us to ignore crucial nuances about which specific parts of the curve are most predictive, or the duration and magnitude of an inversion. Focusing only on the simple fact of an inversion without this deeper context can lead to premature or delayed reactions that needlessly erode your hard-earned wealth. It's like hearing a single instrument and believing you understand the entire symphony. Let us dissect the yield curve not as a simple on-off switch, but as a dynamic market conversation. It's a dialogue between short-term liquidity demands and long-term economic expectations, revealing the collective wisdom or fear embedded in bond markets. To truly decode this, we use a three-step technique. First, differentiate the predictive power of various spreads, the 2-South 10s, 3-month, 10-year, and Fed Funds 10-year. Second, analyze the duration and depth of the inversion. For fleeting versus prolonged signals carry different weight. Third, and critically, observe the steepening of the curve after an inversion. This often serves as a powerful final signal just before a recession truly manifests, a quiet gathering of energy before the storm. George Soros, with his reflexivity theory, understood that market perceptions reflected in the yield curve don't just predict, they influence and shape economic reality. This deeper interpretation moves you from feeling lost in the noise to possessing a quiet, strategic edge. Are you ready to hear the yield curve's true conversation beyond the simple inversion? Have you ever felt that quiet tremor of doubt when an expert forecast, delivered with unwavering confidence, leaves you feeling more uncertain than enlightened? This pervasive fear of financial loss and investment inadequacy often stems from unconsciously adopting the herd mentality of these predictions, without fully realizing they are deeply influenced by human behavioral biases, not just pure, objective data. It's a subtle erosion of confidence, a quiet surrender of your own critical thought to the pronouncements of others. The profound factor that sabotages our ability to critically analyze financial data is a powerful combination. Authority bias coupled with anchoring bias. We tend to uncritically accept the first expert prediction we encounter, then subtly seek information to confirm it, rather than independently dissecting the underlying realities. This mental shortcut, while seemingly efficient, hinders truly independent thought and analysis, trapping us in a cycle of reactive decision-making. It's a comfortable prison built from the opinions of others that keeps us from our own financial truth. Consider the story not of a specific person, but of a mindset, that of the analytical skeptic. This intellectually curious individual who naturally distrusts superficial explanations once pondered why a widely respected economic institution missed a significant downturn. It wasn't a lack of data, it was the insidious grip of groupthink and the subtle calculus of career risk aversion, where prioritizing consensus subtly overshadowed the pursuit of contrarian truth. The no wasn't in the numbers, but in the human dynamics of the institution itself, a profound lesson in looking beyond the surface. To truly discern genuine insights from biased predictions, we can embrace a three-step behavioral finance technique. First, gently inquire into the forecaster's incentives, considering institutional pressures, media attention, or even political alignments. Second, actively seek and cross-reference diverse, even contrarian viewpoints, those voices not widely amplified by the mainstream. Third, and most crucially, focus on the underlying data, the assumptions made, and the methodology employed, rather than solely on the sensationalized conclusion. Society, in its haste, often distorts the image of the independent, data-driven investor, dismissing skepticism as cynicism or stubbornness. Yet, a critically questioning mindset is the foundational pillar of true financial mastery, a quiet resilience against the currents of market manipulation and herd mentality. Are you truly willing to cultivate this independent spirit, to trust your own discerning eye above the loudest voices? Have you ever felt a quiet unease, a subtle distrust, when mainstream reports speak of economic health, yet something deeper whispers a different story? It's often because the true early warning signals, those embedded in the shadow markets of corporate credit, are rarely brought into the light. This leaves us feeling unprepared, vulnerable to systemic liquidity crunches and cascading defaults that ripple through the system long before they hit the headlines, fostering a quiet frustration with the opacity of conventional financial wisdom. There's a widespread myth that economic stability rests primarily on consumer spending alone, but the deeper truth, one rooted in the very bedrock of capital allocation and risk management, reveals a different mechanism. Corporate access to credit, the health of their balance sheets, and their ability to service debt often precede consumer behavior shifts and broader economic contractions. These are the silent tremors that precede the earthquake, the fundamental levers that dictate the economy's true resilience. Let us unpack the credit cycle as the very heart's blood flood of the economy. When this vital flow begins to constrict, the entire system starts to starve, not with a sudden collapse, but with a gradual weakening. This crucial process unfolds long before official recession calls or widespread unemployment become apparent, painting a picture of distress that few are taught to truly see. Understanding this flow is to understand the economy's very pulse. To discern these genuine underlying mechanisms of credit health, we employ a three-step strategic finance technique. First, carefully monitor corporate bond spreads, especially the widening gap between high-yield and investment-grade bonds, which can signal increasing risk aversion. Second, track commercial paper issuance and its rates. A sudden spike or drop can indicate short-term corporate funding stress. Third, analyze corporate debt-to-equity ratios and interest coverage metrics, revealing the fragility or strength of a company's leverage. The fatal mistake for those seeking actionable, rigorously data-backed financial strategies lies in focusing on superficial news and consumer confidence surveys, like trying to read a financial forecast written in sand on a windy beach. Instead, we must turn our gaze to the hard, albeit complex, data of credit markets. This data, often overlooked, truly dictates the flow of capital and holds the hidden truths of impending economic shifts. Are you willing to look beyond the surface to feel the true pulse of the economy in its deepest currents? Have you ever felt a deep philosophical wound, a quiet questioning of the market's fundamental logic, when you're repeatedly fed the comforting narrative of a soft landing only to witness economic downturns that seem to defy all official predictions? This pattern of hope followed by stark reality can lead to profound frustration and a quiet distrust, leaving you wondering if the system is truly as rational as it claims. It's an ache born from the disconnect between what you are told and what you observe unfolding. Beware of the subtle error of optimism bias, which often wears the mask of conviction. This bias can cause us to unconsciously ignore historical evidence where central bank interventions, despite their best intentions, frequently lead to unintended consequences and prolonged adjustments, rather than perfectly engineered smooth transitions. It's a comforting illusion, this belief in a gentle glide, but one that can blind us to the storm clouds gathering on the horizon. Consider the profound insights of George Soros and his reflexivity theory. Soros understood that market participants' expectations and actions are not merely a reflection of reality. They can actively reinforce and shape initial trends. This dynamic interplay makes truly soft landings inherently difficult to engineer, especially when collective sentiment shifts. The market isn't just reacting to facts, it's creating them through its own perception and behavior, a powerful, almost mystical feedback loop. To truly discern these genuine underlying mechanisms of market reflexivity, we can embrace a three-step behavioral finance and macroeconomic analysis technique. First, identify the prevailing market narratives, those widely accepted stories, like inflation is transitory or rate hikes are priced in. Second, analyze how these narratives subtly influence real economic decisions, from corporate hiring strategies to consumer spending patterns. Third, and most crucially, actively seek out disconfirming data, those quiet signals that challenge the dominant narrative, indicating a potential reflexive shift where reality itself begins to adjust to perception. The very reward system of our brains, the dopamine hit we get from learning or discovery, might subtly hinder our empowered, data-driven decision-making. When the feel-good narrative of a soft landing triggers that pleasant rush, it can make it harder to engage with the uncomfortable, critical analysis of potential downside risks and the true, complex nature of economic transitions. Are you willing to look beyond the soothing narrative to embrace the rigorous truth that sets you free? We have journeyed together through the often obscured landscape of recession prediction, moving beyond superficial headlines to uncover deeper truths. We've seen that true insight isn't about clairvoyance, but about cultivating a critical eye for leading indicators, understanding the subtle mechanics of market cycles, and maintaining a vigilant awareness of the behavioral patterns that sway collective sentiment. It's a quiet courage, this commitment to look beyond the obvious, to discern the whispers of the market before they become shouts. This path demands independent thought, a healthy skepticism towards conventional narratives that often simplify complex realities. It empowers you to forge your own understanding, to build a framework rooted in data and timeless principles, rather than being swept away by the currents of market noise. For in this journey, the greatest challenge often lies not in the market itself, but within. As Benjamin Graham, the sagacious mentor of value investing, once reminded us with profound simplicity, the investor's chief problem, and even his worst enemy, is likely to be himself. Mastering recession prediction, then, ultimately means mastering your own biases, your own emotional responses to volatility, and finding that calm center amidst the storm. Now, the invitation is clear. Integrate these data-driven insights and critical thinking frameworks into the very fabric of your investment process. Shift from a reactive stance, constantly chasing headlines, to a proactive proactive one, understanding the deeper rhythms of economic cycles. Let this newfound clarity transform your approach, allowing you to build a portfolio that is not merely diversified, but truly resilient, capable of weathering any economic tide. Will you choose to develop your own robust, critical framework to continuously question assumptions and to build a portfolio that stands firm against economic cycles? This is your opportunity to transform uncertainty into a quiet, profound opportunity, paving the way for sustainable wealth accumulation and a deeper financial mastery.